What I Learned Losing $1 Million by Jim Paul and Brendan Moynihan. Book Summary. Jim Paul and Brendan Moynihan's What I Learned Losing $1 Million is a highly entertaining and accessible account of an individual who lost a lot of money while investing in stocks. In the process, it shows its readers what to do and what not to do when investing in the markets yourself. This book cannot be summarized or explained without detailed reference to its authors, and with a title like What I Learned Losing $1 Million, one can guess why that is. The late Jim Paul was born into a poor background in the state of Kentucky, but he did very well in business in the city of Chicago, so much so that in the 1970s he was appointed to the Board of Governors of the Chicago Mercantile Exchange. This was based on his smart investing strategy, and as he admitted himself on many occasions, a few lucky breaks. But it all went drastically wrong in the early 1980s. Paul became overconfident about his successful investment strategy and he made some very risky decisions. At one point, he was losing over $20,000 a day, and this continued for months on end. These led to large losses of money his brokerage firm was handling, and as he tried to recover the money he had lost, the problem simply got worse. Eventually, when what he had done was fully discovered in 1983, he was fired from the brokerage firm he worked with. His reputation as an investment manager was destroyed, and he had also lost $1.6 million of his own money, a sum equivalent to nearly $5 million today. But this wasn't the end of his time in finance and investments. Paul spent several years getting himself back on track, and by 1990 he was working for the Futures Research Department at Morgan Stanley. There, he was placed in charge of a team of advisors which included Brendan Moynihan. Together, they authored and published this book in 1994 to offer tips on what Paul had learned from his own catastrophic downfall and their advice on investment strategies in general. Much of What I Learned Losing $1 Million is about recounting Paul's story, but then it moves beyond this to examine why he made the mistakes which he did. One of Paul and Moynihan's key messages here is to always monitor your own decision-making to try to avoid the pitfalls Paul fell into. For instance, one of Paul's major mistakes was he invested large sums on soybean oil positions. But a combination of developments in the early 1980s caused the market to drop out of this particular product. Yet rather than disposing of his risk exposure as a small loss, Paul decided to keep his positions in the belief that the market would rise again. It didn't, and he lost vast sums of money on it. His hubris about his previous successes in investing in the 1970s had blinded him to the possibility that he could be wrong and lose big. There are many other bits of advice here. Paul and Moynihan, for example, argue that losses in investing are largely avoidable if you understand crowd behavior and how to steer clear of bad decisions based on it. They cite the example of the tulip mania which ran through the economy of the Dutch Republic in the middle of the 17th century. This began with some merchants speculating on what were valuable tulip seeds at the Amsterdam Stock Exchange in the 1630s. But in the months that followed, people all over the Dutch Republic began investing in these. The price ballooned upwards, and when the bubble burst after a little while, some people lost everything they had. It was a classic example of how the crowd getting in on an investment opportunity can create a very dangerous bubble. A similar example today might be the cryptocurrency market. Most importantly, they note that you should always plan out your investments in minute detail. Never invest based on spur-of-the-moment gut instincts. This is a surefire way to lose your money. Here, Paul and Moynihan cover their own personal experiences of working for Morgan Stanley. Throughout the 1980s and early 1990s, i.e. the years leading up to them writing the book, the investment firm had made some very shrewd decisions, always based on extensive research and planning before they acted. Some people criticized their approach, saying that they often moved too slow on investments to make a real killing. But the reality was that by moving slightly slower than some other investment firms, they didn't make the same mistakes that some of those investment firms made. Paul and Moynihan are adamant here that this advice shouldn't just apply to large investment firms like Morgan Stanley. Even an individual with a small bit of extra money they want to invest should approach things in the same way. Make a plan for how you will do it. Write down the pros and cons of individual investment strategies. Set down rules for how you will proceed with the investment, i.e., when you will accept that you have made enough profit on an investment if it goes right, and you walk away with your winnings. Or conversely, when you will cut your losses if something goes wrong. Goodness knows you don't want to end up long like Jim Paul with oceans of soybean seeds that are worth less and less every day. And the message of Paul and Moynihan's book is that you won't end up in that situation if you follow their cautious and effective investment strategies. And that is it in a nutshell. What I Learned Losing $1 Million, a cautionary tale and a brilliant guidebook through the often perilous world of investing, one which will teach you how to be successful in your investment strategies and how to avoid making the same mistakes that Jim Paul did back in the early 1980s.